Mona Mahajan, Edward Jones, senior investment strategist, joins us now. Mona, it's great to see you, and that's exactly where I want to start, because we had 2 years of just torrid gains for the S&P 500, and right now it seems like investors have a wall of worry to climb. So not surprising to see a little bit of a pullback or some skittishness here?
Yeah, absolutely. It's a great call out. And look, 2 years of 20% plus gains in the S&P 500. And we've actually started the year remarkably well. The S&P is on pace for about a 3.5% gain thus far this year. 10 of the 11 sectors of the S&P 500 are positive for the year. And this is probably underpinned still by an economy that continues to deliver. So we are continuing to see, for example, GDP now at 2.3% for the first quarter of the year. We continue to see earnings growth. You know, Q4 was probably around 16%, the highest year-on-year earnings growth figure since 2021. And of course, the labor market thus far continues to show signs of resilience as well. So all good signs for continued positive economic growth. To your point, though, do we see the potential for some softening? The uncertainty around tariffs probably does put that to the forefront. But we've also seen companies, bellwethers like Walmart, provide a little bit of cautious guidance. We've seen retail sales come in softer than expected. So there are some signs of a potential softening in the economy, but barring an outright downturn or historically Fed rate hikes, neither of which we see on the horizon, we think the underpinnings of this bull market remain intact.
Okay, so the soft data we got this morning, including flash PMIs, existing home sales that were a little weaker than expected, and consumer sentiment, doesn't sound like that's bothering you here. We've been talking a lot about the broadening out of this rally. What would you be buying right now, right here?
Yeah, look, I think the theme for 2025 has to be diversification. If the theme of 23 and 24 was narrow portfolios, mega cap tech, what we'd say is in the U.S., we continue to like both large cap and mid cap, but this is really across growth and value sectors. So when you look at earnings growth for 2025, it's really going to be driven by tech and non-tech parts of the market. That we think supports the ongoing broadening of sector leadership. We also, within the investment grade bond portfolio, look, yields are around 4.5% still on a 10-year treasury. So for those of us that are maybe nearing retirement or looking for income, that is a pretty good 10-year, almost risk-free yield to lock in. If we get above 4.5% again, could be a good time to extend duration as well. And international equities, they have started to show some signs of life. We still continue to see outperformance coming longer term from the U.S., but the idea of diversifying and having some exposure to those parts of the market as well really has paid off thus far this year.
Yeah, best start for Europe in several years. Mona, these regional Fed surveys all week, Empire prices paid, 2-year high. Philly Fed prices paid, 2-year high. Just now, UMich 5 to 10-year inflation expectations, highest since 95. I just wonder whether you think directionally yields are set to go higher rather than lower in the near term.
Yeah, look, I think the inflation story continues to remain one of we haven't yet reached the Fed's 2% target. And we are getting, we have been moving in the right direction. We, of course, on headline CPI, we're at 9% in June of 22. We're back down to about 3%. But we do think we could remain range bound in this kind of 2.5% to 3.5% inflation environment. The good news probably, though, even with the potential for tariffs on the horizon, we don't see a return to kind of a 4% plus CPI environment. In fact, if you look at the Fed research, 2018, 2019, with the tariff environment, inflation was up 10 to 30 basis points. Growth fell 30 to 50 basis points. So there is this idea that you could get perhaps some elevated inflation, but not back to the magnitude that we've seen in recent history. And we think markets can continue to perform well in that environment.
Okay. Mona, thanks for joining us.